Warning: human emotions are an investor's enemy. Do not listen to people who use the word crash in their videos or dialogue. Crash is an emotionally charged word that cannot be quantified. Deal with facts. Avoid emotional investing. Thank you for watching this video. Today we will be doing market analysis on the S&P 500 for the week ending Friday, November 4th, 2022. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. My name is Rodney Constable. I have over 30 years of investing experience, including over 25 years of experience trading stocks and options. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the developer and president of Simple Market Signals at simplemarketsignals.com. We will come back to this chart in just a couple of minutes, but I want to move over to a weekly chart of the S&P 500. So this is a one-year weekly candlestick chart of the S&P 500. In this way, we can take a look at what's been going on over the last year and look at what happened this week. So for this week, we were down 3.35% on the S&P 500 and closed at 3770.55. Now, we know that the all-time intraday high on the S&P 500 happened in January 4th to be exact, 48.1862. And the lows so far of this downturn, we just barely undercut the 3,500 level, and we kissed 3491.58 back on the 13th of October. And, of course, we've had a little bit of a counter-trend rally over the last few weeks. Now, this week, obviously, it stalled out. So we'll have to see, over the next few weeks if we can regain this momentum. But this was a pretty volatile week, and we'll take a look at that here in just a second. Now, this blue line here, guys, denotes the bear market, right? So anything below, I know a lot of people, we're in a bear market, but let's be technically accurate, all right? Let's not fall victim to emotion. Let's use the exact science, right, and mathematics of technical analysis. So if you are truly going to be in a bear market on the S&P 500, you need to be down 20% or more from your all-time intraday high. So if we take that 48.1862, subtract 20% from that, we get 38.5489. That's this blue line here, all right? The reason this is important is the previous week we had closed above that level and came up to just this, just right at that 3,900 level, and that took us out of bear market territory. So we were technically in a correction. This week, obviously, we rolled back over, so we are now back in bear market territory for the 8th week. And looking at this on a closing basis, we have 8 weeks now in calendar year 2022 where we've closed in a bear market. All right, now, this chart here is a daily candlestick chart of the S&P 500, and it's good through Friday, October 28th. Now, why am I showing you this? Because, guys, this is a chart that was in my newsletter a week ago to my subscribers, all right? So I want to show you what you're missing, but this also shows you the importance, right? If you're not a subscriber to Simple Market Signals, this is some of the information, guys, that you're missing, all right? And this is just one of many, many benefits of being a subscriber, and I'll give you a little bit more information at the tail end of this video on this. But this also is going to show you how important this particular level that we're going to talk about is. So this is the exact chart, guys. There's no alterations, no changes. This is the chart that was in the newsletter a week ago. And what I wrote to my subscribers is right here. The 3,900 level has been a very important support and resistance level on the S&P 500 since May. A successful upside breach of 3,900 will be necessary for the current counter trend rally to continue. Again, this was a week ago. This is the counter trend rally. We know, right? We already looked at the fact that we hit that 34.9158 level right here. All right, so that's what we're looking at. And we're looking at this counter trend rally that had been about 2.5 weeks in the making at that point. And we can see on Friday the 28th, we stopped right there, right? And this is what we talk about right here. So after touching 34.9158 on 10/13, circle bottom right here, the S&P 500 has rallied back to 39.0106. All right. as of 10/28. So again, I'm going back over what I posted, what what was in the newsletter a week ago. So I want you to understand that, and then I'll get you the update here, okay? But we came right up to and barely breached that upside. But remember, I warned my subscribers, and by the way, the 3,900 level, you can see the trading right down to this level, and these are daily candlesticks, but you can see we really had, very little closes. We had some trading, right, the tails of the candles below that 3,900, but you can see that 3,900 level just acted as a break, right, a real hard support level, real solid support level back here in May on the S&P 500, and then we rallied back above that, came right down to it, and then once we fell below it, right, prior support acts as resistance once penetrated to the downside. You can see that for June and the first half or so of July, 3,900 acted as overhead resistance, and then we were finally able to break back above this 3,900 level, and that gave us this rally, right? So this was that 2-month rally, right, that we had in that counter trend rally that we had in the S&P 500 from mid-June to mid-August, and then we stalled out and we came down, and you can see on these daily candles we stopped right there and bounced off of this 3,900 level in September, rallied for a few days and fell down again, stopped right there, and then finally broke below 3,900 level, the 3,900 level once again in the middle of September. And then from there, the market fell all the way down to just below that 3,500 level. We spent just literally about 10 minutes below 3,500 before starting this counter trend rally. All right. Now let's go to this week, okay? Because I wanted to give you the close up. So here's the close up of this week. All right. So here is October 31st, right? So this is Monday, right? So this is now this week, and then we'll get back to that chart again so you can see what it looks like. But I wanted to give you the close-up, right, and show you how volatile this week has been. And this week, as you can see, and these are 10-minute candles, by the way. This is a 5-day, 10-minute chart of the S&P 500. And as we can see, on Tuesday, November 1st, we gapped up above 3,900 for that first 10 minutes, and then the second 10-minute candle, as we can see here, reversed course, and the market fell. And then, of course, we know that we had the Fed announcement on Wednesday, the 2nd, where they raised interest rates another 75 basis points. And initially, as we can see right there at 2 o'clock, the market rallied and then rolled over and fell hard and fell down to slightly below and just barely kissed and just traded below that 3,700 level. And then you can see the volatility. And even the volatility today, right? This is Friday the 4th when I'm making this video for you. But you can see the volatility that we had in the stock market just today, where we were positive, negative, positive, negative, positive. So super, super volatile week this week in the stock market on the S&P 500. And you can see that we have been now rejected at that key 3,900 level. So this is what it looks like. The same chart, all I've done it now is extended out for the week. So this is, again, where I warned my subscribers back on the 29th, right? The newsletter comes out every Saturday, but I warned, right? So if you guys were my subscribers, you would have known, and you would have had this information ahead of time, and you would have been able to watch this. But we can see here, right? We got rejected, as I said was likely, and I warned you if you were a subscriber, and we can see what has happened, okay? And so, now, guys, knowing, right? I mean, this goes clear back to May now, knowing how important this 3,900 level is, and we've gotten handily rejected. I mean, we just came right up to this level and stopped, right? So now that we've gotten rejected at this level, it's going to take some extra strength, right? Some extra momentum to turn this last ugly, volatile week around and get the S&P 500 back to this 3,900 level and then above, all right? So this counter trend rally has been interrupted. It doesn't mean it can't carry on after this break, right, to the downside. It doesn't. I mean, we had some breaks in this 2-month counter trend rally from the middle of June to the middle of August. So it's possible, right, just like we had these, a couple of downside movements during this 2-month burst, from June to middle of August, it's possible that that's exactly what we've experienced here with something like this, and then we can get back up to this, and you can see that 3,900 level was a very important support and resistance level back during the last counter trend rally. So it's possible that we can rally back to and through this level and possibly get back up to this green line here, which by the way is the 40-week moving average, and you can see the rally that we've been talking about from mid-June to mid-August. That's this movement here. Now we're back to looking at weekly candlestick charts of the S&P 500 candlesticks, and you can see what has happened here, and we got right to the 40-week moving average, pretty equivalent to the 200-day, of course, and then we rolled over and fell from there. We had a rally back here, right, another counter trend rally back in late February and through the middle of March, and we had a couple of weeks where we traded above the 40-week moving average, failed again. We had one back here, so just going backwards, right? And obviously we peaked in first week in January and then fell for a few weeks, rallied back above the 40-week, down, back above it, down, back to it. Had a little trading above it, but no weekly candles closing, no weekly closes above the 40-week moving average since clear back here in March, all right? So if we can resume this upward trajectory on the S&P 500, I think a likely area is somewhere around this, 40, let's call it 4,000 to 4,100. But, at that point, we're going to be trading right around that 40-week moving average. So that is possible, guys. But first, we're going to have to get back up through this 3,900 level, all right? And now that we've been rejected and we know how important this 3,900 support and resistance level has been on the S&P 500 since clear back here in May, we know really how important it's going to be, right? So this is a super, super important level to watch, all right? Obviously, if we cannot regain some momentum, then we're going to probably roll over and undercut this 3,500 level and fall even lower, all right? Now, I want to show you here a chart of 2018. Now, why am I showing you this chart, and what is this? All right, guys, stay with me because this is super, super important, all right? These are the exact signals that were generated by the Simple Market Signals proprietary model, which took me over 20 years to develop. I developed it for myself, but this is the exact 2018 chart, all right? And what we can see here is I've distilled. It's a composite signal with a plethora, a ton of information behind it. And it took me over 20 years to figure this stuff out, guys. And remember, I'm a former financial advisor, former VP of a major mutual fund company. I've been in one way, shape, or form the financial services industry since 1987. I've been at this a long time, all right? Trader, investor, ran money for other people. So, do not discount what I'm sharing with you here. For the right people, this could be worth a lot, all right? So what I've done is I've distilled my model signals down to a simple green, yellow, red signal. And as we can clearly see, right, most all of your upward progress in the stock market is going to be made under a green signal. Your biggest losses in the stock market will be made in a red signal environment, and the yellow signal is a sideways to slightly up or down signal, all right? I mean, it's that simple, guys. There is a ton of information, but it's internal information that took me 2+ decades to figure out, all right, through a process of elimination, looking at a bunch of different indicators, figuring out which ones actually worked and which didn't, then, diving into breadth, and, but when you're working with breadth, you need to understand what breadth indicators and what levels to watch and what's important. And again, I reverse engineer the stock market. I just want to spend a couple seconds on this so you fully understand. I'm not targeting a certain time frame. That was not my goal. My goal was to figure out how the stock market actually worked, and I was looking for telltale, repeatable signs like a person's vital signs, right? Your blood pressure, your temperature, things like that were present in the market virtually every time there was an upward move, virtually every time there was a downward move, and virtually every time there was a sideways to slightly up or down move. And that is what I was able to figure out. And then I built, and then that data became my model. And it finally came together for me in 2017. And here is the first, and nothing has changed. I mean, this is exactly the signals that were generated. And guys, this is in my newsletter every week for pennies a day. You can get access to not only these charts, right, technical work, market analysis, but you can get access to my proprietary information, all right, my proprietary signals. And, you know, I've had people, several people over the last couple of years that have told me that this information has helped them either make or save tens of thousands of dollars each year. All right. I had, you know, one guy last year said, look, he was telling me I was going to get out of the market. I was scared. The market was at an all-time high, but your information kept me in the market. I made tens of thousands of dollars in my 401k that I otherwise wouldn't have made. I had a guy just a couple weeks ago tell me that in his wife's retirement account, this information, these signals have helped them save tens of thousands of dollars this year that they otherwise may have lost to the markets because they're looking at this information and applying it according to what they, you know, to their account, right? So, guys, stay with the video for another couple of minutes. Let me share a little bit more information with you about this. But I'm telling you guys, take this stuff seriously because this can make a huge, huge difference in your life going forward if you let it. Do you manage any of your own money, including in your 401k or IRA? Are time and money important to you? If time and money are important to you, then simple market signals should be important to you as well. Simple market signals is for business owners, busy corporate executives, and other professionals who want to cut through the stock market BS and get down to the facts. If you value your time, if you value your money, you need Simple Market Signals. Simple Market Signals is based on a proprietary formula developed by a former financial services professional with decades of real-world experience. Simple Market Signals is equity investing information simplified. Simple Market Signals saves you time and helps you understand market trends and risk management in a way few enjoy. Just try it. There's no contracts. You can cancel anytime, and a subscription to this information is less than 67 cents per day, and it's priced way less than it should be for the value it brings. To learn more, go to simplemarketsignals.com and watch this video that's on our homepage. So again, go to simplemarketsignals.com and watch this video that's on our homepage. Again, that website is simplemarketsignals.com.